Most traders don't fail because they lack information. They fail because they misunderstand how markets actually work, and more importantly, how their own minds work inside uncertainty. The stock market is not designed to reward intelligence, opinions, or effort. It rewards alignment with probability, emotional neutrality, and unwavering consistency. Legendary traders didn't win because they predicted the future. They won because they accepted that they could never know what will happen next, and they built rules that work because of that fact. These principles are not new. They are not flashy. They don't promise excitement. And yet, decades later, they still work because human psychology has not changed and uncertainty has not disappeared. This is not a speech about strategies. This is about principles that remove fear, greed, and hope from your decision-making. When you truly understand these rules, trading stops being emotional and starts becoming inevitable. Most traders enter the market believing that success comes from prediction. They believe that if they analyze enough charts, indicators, or news, they will eventually eliminate uncertainty. This belief is the root of almost every emotional mistake made in trading. The market does not reward prediction. It rewards alignment with probability. The moment you accept that you cannot know what will happen next, you take the first real step toward consistent profits. Randomness does not mean chaos. It means that individual outcomes are independent of one another, even when a method has an edge. A trading system can be profitable over time while producing losses at any moment. This is not a flaw in the market, it is the nature of probability itself. Legendary traders understood this deeply. They did not expect any single trade to validate their intelligence or skill. Each trade was simply one event in a long series where the edge would eventually express itself. The human mind is not naturally equipped to deal with randomness. We are wired to look for patterns, assign meaning, and avoid uncertainty. In everyday life, this helps us survive. In trading, it creates emotional interference. When a trader believes the market should behave in a certain way, every deviation from that expectation feels personal. Fear arises when the market moves against the position. Greed appears when it moves in favor. Hope enters when a loss is not accepted. All of these emotions are symptoms of resisting randomness. The moment you truly accept that anything can happen, emotional reactivity begins to dissolve. If anything can happen, there is no reason to be surprised by a loss. There is no reason to celebrate a win as proof of correctness. Both outcomes become neutral events. This neutrality is not indifference, it is clarity. Clarity allows you to execute your rules without hesitation or impulse. Most traders say they understand that losses are part of the game, yet emotionally they still fight them. This internal conflict is why discipline feels difficult. Discipline becomes effortless only when there is nothing to fight. When a loss is expected, accepted, and fully integrated into your mindset, there is no pain to avoid. There is only execution. Accepting randomness also removes the need to be right. The need to be right is one of the most destructive psychological forces in trading. It ties your identity to the outcome of a single trade. When your self-worth is connected to being right, every loss becomes a threat. That threat triggers fear, denial, and revenge. Legendary traders detach their identity from outcomes. They did not define themselves by any single result. They defined themselves by how well they followed their process. When you no longer need to be right, you become free to follow your edge. You stop second-guessing entries. You stop moving stops to avoid pain. You stop taking profits early to lock in emotional relief. These behaviors disappear not because you force them to stop, but because the emotional fuel that drives them no longer exists. Randomness also teaches patience. If outcomes are uncertain in the short term, but reliable over a series of trades, then impatience makes no sense. You do not rush probability. You allow it to unfold. This is why professional traders think in terms of sample sizes, not individual trades. One trade means nothing. 10 trades mean very little. 100 trades reveal the truth. Patience is not waiting. It is trusting the process without needing immediate confirmation. Many traders confuse confidence with certainty. They believe confidence comes from knowing what will happen next. In reality, true confidence comes from knowing that you can handle whatever happens next. When randomness is accepted, confidence shifts from prediction to preparation. You no longer need the market to cooperate. You are prepared for all outcomes. That preparedness is what creates emotional stability. Another powerful effect of accepting randomness is that it removes fear of missing out. When you believe that the next trade must be the one, Every missed opportunity feels painful, but when you understand that opportunities are endless and outcomes are random, missing one trade has no emotional weight. There will always be another opportunity that fits your edge. This mindset keeps you selective and disciplined instead of reactive and impulsive. The market does not know you exist. It does not reward hope, effort, or suffering. It simply moves. When you accept this fully, you stop trying to negotiate with it. You stop asking it to make sense. You stop expecting fairness. You align yourself with its nature instead of fighting it. This alignment is where consistency begins. Accepting randomness does not make trading easy. It makes it simple. Simple does not mean comfortable. It means clear. Clarity is W. Hat allows you to act without emotional distortion. When you see the market clearly, you respond instead of react. You execute instead of hesitate. You follow rules instead of emotions. Consistency is not the result of winning trades. It is the result of consistent behavior. And consistent behavior is only possible when randomness is fully accepted. Without acceptance, every trade carries emotional weight. With acceptance, every trade is just another event in a probabilistic process. In the end, the market will always be uncertain. That will never change. What can change is your relationship with that uncertainty. When you stop trying to control outcomes and start trusting probability, the market loses its power over your emotions. At that point, profits are no longer something you chase. They become the natural byproduct of disciplined execution over time. Most traders spend years searching for an edge, believing that once they find the right strategy, consistency will follow automatically. They believe the problem is technical, not psychological. This belief keeps them trapped in an endless cycle of system hopping. The truth is far more uncomfortable. An edge has no power on its own. Without consistent execution, even the best edge in the world is completely meaningless. An edge is nothing more than a probability advantage over a series of trades. It does not guarantee a win on the next trade or the one after that. It only guarantees that, if executed flawlessly over a large enough sample size, the outcomes will favor you. Most traders intellectually understand this, yet emotionally, they still expect the edge to perform immediately. When it doesn't, doubt enters. Doubt is the enemy of consistency. The moment a trader doubts their edge, execution begins to break down. They hesitate on valid setups. They skip trades after a loss. They take marginal trades after a win. These behaviors are not random mistakes. They are emotional responses to short-term outcomes. The edge hasn't failed. The trader has abandoned it. Consistent execution is difficult because it requires emotional neutrality. You must execute the same rules regardless of how you feel, what just happened, or what you think might happen next. This is where most traders collapse. They allow recent results to influence present decisions. In probability-based environments, this is fatal. Legendary traders understood that discipline is not about effort. It is about structure. They did not rely on motivation or willpower. They built rules so clear and specific that there was nothing to debate in the moment of execution. When a setup appeared, the trade was taken. When risk was defined, it was accepted. When an exit was triggered, it was executed. There was no room for interpretation, and therefore no room for emotion. One of the greatest illusions in trading is the belief that flexibility improves results. In reality, flexibility usually means emotional permission to break rules. Cons. Consistency requires rigidity in execution, not in thinking. You can refine your edge outside market hours, but during execution, rules must be followed without exception. Every deviation weakens the statistical power of the edge. Traders often sabotage themselves by measuring success trade by trade. This measurement creates emotional feedback loops. A winning trade reinforces bad habits. A losing trade discourages good ones. Legendary traders measured success by how well they executed their plan, not by the outcome of any single trade. This shift in measurement is critical. When execution becomes the goal, profits become the byproduct. Fear is the primary reason execution breaks down. Fear of loss, fear of being wrong, fear of giving back profits. These fears do not come from the market. They come from an incomplete acceptance of risk. If risk is not fully accepted before entering the trade, fear will surface during the trade and override logic. Consistent execution is impossible when fear is present. Greed is just as destructive. Greed convinces traders to overtrade, oversize, or abandon exit rules. It creates the illusion that this trade is different, that it must be maximized. Greed thrives when traders focus on money instead of process. Legendary traders focused on flawless execution, knowing that money would follow. Another obstacle to consistent execution is the need for confirmation. Traders want reassurance that they are right before acting in a probabilistic enviro. In Ment, confirmation often comes too late. By the time certainty appears, the opportunity is gone. Consistent execution requires acting on incomplete information, guided by rules rather than reassurance. Execution also breaks down when traders personalize outcomes. When a loss feels like a personal failure, the next trade becomes emotionally charged. Traders either hesitate to avoid pain or overtrade to recover. Both behaviors destroy consistency. Legendary traders separated their identity from results. A loss was not a reflection of them, it was simply part of the distribution. Time also exposes execution flaws. Over a large sample size, even small inconsistencies compound into significant damage. Skipping one valid trade, moving one stop, or taking one impulsive entry might seem harmless. Over hundreds of trades, these small deviations erode the edge completely. Consistency is not about perfection in a single moment. It is about reliability over time. The market constantly tempts traders to break rules. Sudden moves, news events, and emotional swings create pressure to act outside the plan. Legendary traders anticipated this pressure. They accepted that temptation would arise and built safeguards against it. Journals, checklists, and predefined rules were not optional tools, they were psychological armor. Consistent execution transforms trading from an emotional struggle into a mechanical process. This does not remove skill or intelligence, it channels them into preparat. Ion instead of reaction. Preparation is where intelligence belongs. Execution is where discipline rules. In the end, an edge only exists on paper unless it is executed the same way every time. The market does not reward ideas, it rewards behavior. When execution is consistent, probability can work. When it is not, even brilliance fails. This is why edge without execution is an illusion. Consistency is the bridge between potential and results. Without it, nothing works. With it, even a simple edge becomes powerful. Most traders believe they understand risk. They talk about position sizing, stop losses, and risk-reward ratios. But understanding risk intellectually is not the same as accepting it emotionally. This gap between knowledge and acceptance is where most trading problems are born. Until risk is fully accepted, trading can never be free of fear, hesitation, or internal conflict. Risk acceptance means more than knowing how much you can lose. It means being completely at peace with that loss before you enter the trade. Not tolerating it, not hoping it won't happen, truly accepting it as a possible and acceptable outcome. Legendary traders reach this state consistently, and it is the primary reason they were able to execute without emotional interference. When risk is not accepted, the mind looks for ways to avoid pain. It moves stops. It exits early. It refuses to enter valid trades. It adds to losing positions in the hope of relief. These behaviors are not mista. In strategy, they are survival responses. The brain is trying to protect you from perceived danger. As long as risk feels threatening, logic will always lose. The market is a risk environment. There is no certainty, only probabilities. Yet most traders enter trades emotionally unprepared for loss. They secretly expect the market to validate them. When it doesn't, they experience shock. That shock is what triggers emotional decision-making. Legendary traders eliminated shock by expecting nothing. Losses did not surprise them because losses were already accepted. True risk acceptance neutralizes fear at its source. Fear does not come from losing money. It comes from losing money that you were not prepared to lose. When the risk is genuinely accepted, there is nothing to fear. The worst-case scenario is already accounted for emotionally, not just financially. Many traders confuse confidence with aggression. They believe confidence means increasing size or forcing trades. In reality, confidence comes from knowing that no single trade matters. When risk is accepted, the outcome of one trade has no emotional significance. It cannot damage your identity or your sense of control. This is real confidence, and it is quiet. Risk acceptance also brings clarity. When fear is present, perception narrows. Traders see only what supports their emotional need. They miss exits, they ignore warning signs, they overreact to noise. When risk is accepted, perception expands. You see the market as it is, not as you want it to be. Clarity is impossible when fear is active. Another powerful effect of risk acceptance is patience. When you are afraid of losing, you want the trade to work immediately. Any delay feels threatening. This leads to premature exits and constant interference. When risk is accepted, time no longer creates pressure. You allow the trade to develop according to your plan. Patience becomes natural instead of forced. Most traders think freedom in trading comes from making a lot of money. This is a misunderstanding. Money does not create freedom, emotional control does. You can be profitable and still be trapped by fear and stress. Freedom comes from knowing that you are emotionally prepared for all outcomes. When nothing the market does can disturb your state of mind, you are free. Risk acceptance also eliminates the need for revenge trading. Revenge trading is an attempt to escape emotional discomfort. It is not about money. It is about restoring a sense of control. When losses are accepted, there is nothing to avenge. A loss is simply a business expense, not an injustice. Many traders avoid fully accepting risk because they believe it will reduce motivation. They think that if they accept losing, they will stop caring. The opposite is true. Acceptance increases professionalism. It shifts focus from emotional outcomes to process quality. Legendary traders care deeply about execution, not about individual wins or losses. There is also a deep connection between risk acceptance and discipline. Discipline is often framed as self-control. But self-control fails under emotional pressure. When risk is accepted, discipline is no longer needed. There is no internal conflict to manage. Rules are followed naturally because there is no emotional reason to break them. The market constantly tests your relationship with risk. Sudden losses, streaks of drawdowns, and unexpected moves are not exceptions, they are normal. Traders who have not accepted risk interpret these events as personal attacks. Traders who have accepted risk interpret them as part of the game. This difference determines longevity. Risk acceptance does not mean recklessness. It means precise risk definition and emotional alignment with that definition. Legendary traders were not careless. They were exact. They knew their limits and respected them. Freedom comes from respecting boundaries, not ignoring them. Over time, risk acceptance transforms trading into a calm, methodical activity. Emotional spikes disappear. Decisions become repeatable. Confidence stabilizes. This state is not achieved through positive thinking or motivation. It is achieved through deep psychological work and repeated exposure to uncertainty with proper preparation. In the end, the market offers no guarantees. That will never change. But it does offer opportunity to those who can operate without fear. Risk acceptance is what makes that possible. When you accept risk fully, the market loses its power to control you. At that moment, trading becomes what it was always meant to be, a probability-based business executed with clarity, discipline, and freedom. Consistent trading is not built on prediction, talent, or intelligence. It is built on psychological alignment with uncertainty. When randomness is accepted, execution becomes consistent. When execution is consistent, the edge can express itself. When risk is fully accepted, fear disappears and clarity remains. These principles are timeless because human psychology has not changed. The market will always be uncertain, but your behavior does not have to be. Freedom in trading comes from discipline rooted in acceptance, not control. When you stop fighting the market and start aligning with its nature, consistency stops being a struggle and becomes a natural outcome.